5 seconds of silence. Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome. Today, we're going to deconstruct one of the most fundamental tools in management accounting, the master budget. Now, the term itself might sound a bit imposing, but our goal here is to transform it from what seems like a complex accounting exercise into a clear, sequential narrative, a story of how a company meticulously plans its future.
We'll proceed through 5 distinct sections. First, we'll establish the foundational principles, really digging into why budgeting is so critical. Then we'll build the budget, starting with its cornerstone, the sales budget, and moving through the operating and financial components. And finally, we'll examine how this framework is adapted for different types of organizations.
So let's begin with Section 1. To truly appreciate the master budget, we must first understand its role. Think of it not as a static document, but as an architect's vision for the company. It's a dynamic tool for planning, for coordination, and, importantly, for control.
At its very core, a budget is the quantitative expression of a strategic plan. It takes the abstract goals and ambitions of management and translates them into a concrete financial roadmap for a specific period, providing clear direction for the entire organization.
And the benefits of this process are substantial. It forces management to look beyond the day-to-day and plan for the future. It sets definite objectives, which are absolutely crucial for evaluating performance later on. It also serves as an early warning system, highlighting potential problems before they escalate. And of course, it facilitates coordination across departments, enhances management's overall awareness, and, when done right, can be a powerful tool for motivating personnel.
All of these individual components come together to form what we call the master budget. Now, it's not a single document, but rather a detailed collection of interconnected schedules and budgets. Each piece informs the next, creating a comprehensive and unified plan of action for the business. This construction process follows a very logical sequence, and it's generally divided into 2 main classes. We begin with the operating budgets. These detail the firm's primary income-generating activities, things like sales, production, and materials. The outputs from these budgets then provide the necessary data to construct the financial budgets, which focus on cash resources and financial position. So where does this entire intricate process begin? It all starts with one single critical component which serves as the foundation for everything else we're going to build, the sales budget.
The sales budget is, without exception, the first budget prepared. It's derived from the sales forecast and represents management's best estimate of sales revenue for the period. Its accuracy is paramount. An error here will cascade through every subsequent budget, compromising the integrity of the entire financial plan.
With the sales budget established, we can now proceed to construct the rest of the operational plan. The sales forecast tells us what we expect to sell. So the next logical question is, what do we need to produce to meet that demand? And that brings us to the production budget. This budget is responsible for a crucial translation. It takes the sales forecast, which is typically expressed in revenue, and converts it into the tangible units that the company must manufacture to meet those sales and to maintain its desired inventory levels. The calculation here is quite straightforward. We begin with our budgeted sales units. To that, we add the desired number of units we want to have in our finished goods inventory at the end of the period. This sum gives us the total units required. From there, we simply subtract the units we already have in our beginning inventory, and the result is the required number of units to produce. Let's apply this to an example. Say Precision Products plans to sell 10,000 units. Management also wants to have 1,500 units on hand at the end of the quarter. That means they need a total of 11,500 units available. Since they're starting with 1,200 units in inventory, we subtract that, and we find they must produce exactly 10,300 units. All right, so we know we need to produce 10,300 units. The next question is, what resources are required to make that happen? This leads us directly to the direct materials budget, which outlines our purchasing needs for all the raw materials. You'll notice this formula follows the exact same logic as the production budget. We determine the materials needed for production, add a buffer for our desired ending inventory, and then subtract what we already have on hand. This ensures we procure enough material for current production while also maintaining a sufficient inventory buffer for the future.
Looking at our Precision Products example again, to produce 10,300 units, and assuming each unit requires 2 kilograms of material, we need 20,600 kilograms for production. We add the desired ending inventory of 2,500 kilograms to get a total need of 23,100. After subtracting the 2,200 kilograms we started with, we arrive at a purchase requirement of 20,900 kilograms. At a cost of $4 per kilogram, our total cost of purchases comes to $83,600.
Following the same systematic logic, we would then prepare the remaining operating budgets. The direct labor budget to quantify the hours and cost needed, the manufacturing overhead budget to account for both variable and fixed factory costs, and finally, the selling and administrative expense budget to project all non-manufacturing costs. With those complete, our operational plan is fully flushed out.
Now that the entire operational plan is complete, it's time to translate all of those activities into their financial consequences. This is the point where we shift our focus from operations to the financial outcomes they generate.
And among the financial budgets, the cash budget holds a position of paramount importance. As the quote notes, cash is so vital that this budget is often considered the most important output of the entire process. It details the anticipated inflows and outflows of the firm's most liquid and most critical asset. The cash budget is typically structured in 3 main sections. You start with cash receipts, which details all sources of incoming cash. Then, cash disbursements, which lists all anticipated payments. The difference gives you an excess or a deficiency of cash. This then informs the 3rd section, financing, which allows management to plan for any necessary borrowing or debt repayment, ensuring the company maintains its desired cash position. The culmination of this entire, detailed process is the creation of the pro forma financial statements. These are our forward-looking projections. We create a budgeted income statement, which shows the company's expected profitability, and a budgeted balance sheet, which projects its financial position at the end of the period. These are the ultimate deliverables of the master budget.
Now, it's very important to recognize that while our example has been a manufacturing firm, this budgeting framework is highly adaptable. It's a blueprint that can be modified for entities outside of manufacturing as well. Take a merchandising company, for instance. Instead of a production budget, it will prepare a merchandise purchases budget. The core question changes from how many units must we make to how many units must we buy. Consequently, a merchandiser omits the detailed budgets for direct materials, direct labor, and manufacturing overhead entirely, simplifying the process.
This brings us to a final critical consideration that moves beyond the numbers and into the human element of budgeting. Because budgets are built by people, there is always the potential for budgetary slack, the intentional underestimation of revenues or overestimation of expenses to make targets easier to achieve. So this leaves us with a key question. How can a company mitigate this behavior to ensure the budget serves as a tool for genuine growth rather than just an easily attainable target? It's one of the most significant behavioral challenges in management accounting.